I want to go through a simple example of the closing process where we have net income in place and we have some balances in these accounts. In this problem, we start out with revenue of $500 and expenses. We're keeping it simple. We only have two expenses, $300 for rent and $100 for salary. We need to close those accounts out. So we're going to do that by debiting revenue for $500, because now its balance is zero, and we'll have an offsetting credit of $500 to income summary. Now, we're going to do the same thing with our expenses. We have a $300 credit to rent expense to close out that account, and a $100 credit to salary expense to close that out. And each one of those gets a corresponding debit to the income summary account. Now, the balance in income summary, got $500 on the credit side, $300 plus 100 is $400 on the debit side. We've got a $100 credit balance in income summary. And that tells us that we had net income. And we know we had net income because revenues of 5 were greater than expenses of 4. Now, we can't leave that 100 in there though. We've got to close out the income summary account as well. We do that with a debit. And if we debit income summary, then we need a credit to the capital account for $100. Now we're almost done here. During the month, owners took $200 out of the business. We need a credit to close that out so that the drawing account is zero, because it's got to be zero so we can put next year's owner's withdrawals in it. And that's going to cause a $200 debit to the capital account. So our capital account ends up with a $900 credit balance. That's what happens when we have net income.